everyone to the policy panel. This is the emerging tradition of this seminar, where we kind of sum up and think about how does this affect policy. I'd like to welcome our guest, Jim Bullard from St. Louis, Charlie Evans from Chicago, and Eric Rosengren from Boston. What we're going to do is I'm going to tee up some questions. No surprise, I'm going to ask them basically their views on the themes of this conference, and not just their views, but how you see the discussion going in the policy community as well as the committee. I'll then ask you if there's an important question I've left out and give you a chance to say whatever really important thing I forgot to ask you. And then we'll move on to questions from the floor. We not only have current bank presidents and FOMC members here, we have some former, can I have hands? Who has been on the FOMC or run a bank previously? Charlie, where are you? Yeah, okay. So you guys, I'll give you guys first shot at comments and or questions, and then we'll move to, I'm just warning you, it's coming. And then we'll go to Q&A from the floor. Okay, so, to be fair, I guess what I'll do is I'll ask a question, and then we'll go this way, and then I'll ask another question, and then we'll go this way. But feel free also to respond to each other, and then when the discussion is petering off, I'll ask the next question. So let's start with where we started the conference, the balance sheet question. What's the new normal of reserves? Should the Fed keep a big supply of interest-paying excess reserves? Should it open access to reserves to non-banks even more? Or should the Fed run monetary policy as it used to do with a very small amount of non-interest-bearing reserves? Or should we continue now with $1 trillion of reserves at least and interest on excess reserves? Or how about my wide open balance sheet, 3%, come and get it? Should the balance sheet be a separate tool? Should we do more QE in the next recession? And that's the liability side. The asset side, does QE work, if you think it does, on the asset side or on the liability side? What kind of assets should the Fed buy? Do you welcome restrictions or pre-commitments, two words for the same thing? Or should the Fed buy widely, MBS, corporate bonds, stocks, whatever it seems it needs? Well, I got plenty of questions for you. So Charlie, why don't you start in and
Gee, John, there's so much there. I'll just take the one that I have an opinion on. Well, I mean, obviously our balance sheet is very large. Everybody recognizes that, and nobody has the expectation that we're going to keep the balance sheet at $4.5 trillion, like where we are. The committee has indicated at a variety of moments that we anticipate a smaller balance sheet, but of course it's not going to be as low as back in 2007 because the economy has grown and there's more currency out there. The minutes have been pretty clear about describing how the committee's had these discussions, and we're actively wondering about the benefits of a larger balance sheet that could be consistent with a floor system for some financial stability reasons, or perhaps going back to previous model where reserves are scarce and we had an active interbank market. There are times where, given my 25 years in the Fed, I have some sympathy for the old model of scarce reserves, and certainly a large balance sheet does open yourself up to political interest weighing in perhaps. But a lot of times Congress would be passing a law anyway to direct you to do these things, and democracy is Congress can pass laws. So I just don't know where we'll be. But the committee's thinking about that. Everybody else is going to weigh in on this? Or?
Sure,
yeah, okay.
Until you get tired of it.
So that's the easy part. Jim, why don't you take the harder part?
I agree with Charlie that the $4.5 trillion level that we're at now for the size of the balance sheet is larger than we would like. So that's why I've been an advocate of beginning to shrink the balance sheet by ending the reinvestment policy. I think we could go down to as low as $2 trillion because the currency is about 1.5 and a couple of $100 billion for reserves would probably get you down to a floor system, although I wouldn't be firm on that, but that gives you an order of magnitude about how far we are away from where we need to be, even if you wanted to run a floor system. So I think we got a long ways to go, and we might as well get started on that. I do think it's one of the questions is, would there be QE in the next recession? I think that's a distinct possibility, and therefore the prudent thing to do would be to create policy space on the balance sheet side as we are on the policy rate side, so that if a future committee wanted to contemplate that kind of policy, if we hit the zero bound in the future, that we'd be able to do so. I also think that we have a rather odd twist operation going on, at least rhetorically right now, where we're raising the policy rate and therefore trying to normalize conditions, but we haven't changed the balance sheet. And according to our rhetoric and our statement, that balance sheet is putting downward pressure on longer term and medium term yields. And so it's a little bit odd to be saying we're going to raise the short-term rate, which would normally be thought to be, all else equal, raising everything along the yield curve. But nevertheless, we're putting downward pressure on the other parts of the yield curve. So I think that that's an inconsistency that needs to be ironed out. And that's another reason why I've advocated getting going on balance sheet normalization. On the QE, on the whether QE works or not, I would challenge people here, because a lot of times you get people saying, oh, QE didn't have any effect. Maybe I heard John Cochran sort of say that yesterday. So let me push back against that a little bit. I think you have a distinct set of empirical facts associated with QE, and any theory that you have has to explain these facts. Because we have experiments in Europe, in the U.S., and in Japan, and it seems pretty clear what happened. Equity prices seem to react a lot. So you really had big movements in equity prices. That's one thing that happened. You seem to have big movements in exchange rates. We saw that in 2014 with the euro. We also saw that in Japan. You also saw important effects on term premiums, longer term interest rates. Those seem to be significant. And then, puzzlingly, for me anyway, not much effect on inflation or inflation expectations. So whatever theory you want to write down, I think has to confront those facts. They aren't easy to confront in a model. And, so don't come to me and say this didn't do anything. It did something, but it's maybe not something that is as conventional as we thought it was. So those are my comments. So thank you.
So I'll just pick on a couple of comments that Jim talked about, and one was, what is the likelihood that we see a balance sheet that's swollen again? And so part of the system design has to be whether you think what's occurring right now is a one-time event or whether it's likely to occur more frequently. And when I think about the summary of economic projections, where we have a long-term federal funds rate that the committee thinks will be around 3%, and you think about how does the Federal Reserve normally respond when we have a recession, it's not at all uncommon to lower the federal funds rate by 500 basis points. So if you have 300 basis points in the longer run for the federal funds rate, but you need to go down by 500 basis points, it means we're going to hit the zero lower bound pretty frequently. So why is it that we're at the zero lower, likely to be at the zero lower bound more frequently? I think there are several reasons. One is one of the benefits that we have right now is that we do have a 2% inflation rate, and I think that inflation expectations are getting well anchored. During previous periods, we had much higher inflation rate. I don't think that's a desirable thing, but the result is there's less of a buffer between where the nominal interest rate is and zero. I think there are two other trends, because it's not just the United States that's encountering this. Japan's experiencing it, and so is Europe. Population growth is much slower than it was a few decades back. That's true in the United States, it's true in Europe, it's true in Japan. It's not only slower births, but it's less immigration, and that's likely to be continuing. And productivity, I agree with Kevin, we don't completely understand why productivity seems as slow as it is, but productivity definitely seems to be relatively slow. So you combine a low population growth, low productivity, and a 2% inflation rate, and it's not all that surprising that much of the committee comes up with a number around 3%. So that means we're going to be here pretty frequently, and if we're going to be here pretty frequently, we need to come up with a system design that is equipped. What are we going to do when we hit the zero lower bound? And so I think it is inevitable that we're going to be talking about balance sheet expanding in future recessions, and I think actually in most recessions, unless they're very, very mild.
Let me push you guys a little bit. I presume you view the QE as working not by so much the issuance of reserves, but by the purchases of assets. You heard Charlie Plosser in our first panel warning about the political pressures to buy certain assets other than other assets, other political pressures to prop up certain prices than other prices. You're taking credit risk, you're taking term risk onto the Fed balance sheet. Does that worry you at all, or do you favor just a pure treasury strategy, or do you think that it's actually the reserves that matter, not the purchases anyway?
So the political economy question certainly worries me. I think it is a significant issue. But we have to deal with the reality that if you're going to have a Fed funds rate that's around 3% and recessions occur, what are you going to do when you hit the zero lower bound? So you need an alternative. In Europe, they've tried negative interest rates. There's probably a limit to how negative that can be until we get some of the new currencies that were talked about in the previous session, but I don't think that's likely to happen in the near term. And so we need an alternative of what we're going to do when we do hit the zero lower bound. So in discussing what the Federal Reserve should do, we're going to probably be confronted with a situation that, once again, inflation's below 2%, the unemployment rate's very high, and the short-term interest rate is at zero. Right now, I do think that there is a fair amount of empirical evidence that the large-scale asset purchases did make a difference. Let me just finish.
Oh, yeah, please.
The long-term treasuries did move down, and I think actually you can even look more recently as we've gotten closer to normalization and when we've stopped the purchase program, but the Europeans and the Japanese have not. Their 10-year treasuries are much lower than our 10-year treasury, and I don't think it's necessarily because they're viewed as much better credit risks than the United States. I think part of it is that they have a very different monetary policy than we have right now. And I would say when I give talks, particularly to financial audiences, they spend much more time asking me about the balance sheet than they do about the federal funds path, which tells me at least financial market participants think that it matters. So I think there is a fair amount of empirical evidence that it's had an effect. I do think it lowers long-term interest rates, and I do think it had an impact on the economy, and I think it's one reason why the U.S. is at full employment or possibly a little bit below, and why inflation is pretty close to 2%, and those countries that waited much longer before they engaged in quantitative easing are not nearly as far along as we are.
But I guess let me put the question and invite the other, I don't want to turn this into the end of the table discussion. Is this something that needs a strategy, a plan, a rule, what assets you buy, when you buy the assets? Or is it we'll go into the firehouse and pull out whatever we think when the time comes?
I think the near term, I think this conference is very good on this. I think the near term challenge for the Fed is to realize that we're probably going to have to at least have QE available in the future. So that's I think we should be creating policy space for that. And then how to incorporate QE into the Fed's arsenal without bringing up the kinds of political economy problems that people have outlined here, which are very serious. So, be able to pursue a policy like this up and down and not get the institution off track. That would be, my near-term goal for Fed strategy.
We are constrained in the assets that we can purchase. We cannot buy equities. We can't take risk like that. The Federal Reserve Act doesn't allow us to do that. So we buy treasuries, and we bought MBS. And, now this is not a great thing in the sense, what I'm about to say is, if our MBS defaulted, we would get paid back. That's going to be coming out of, the guarantees there. But, from the Federal Reserve and safe assets, they have to be safe. Now, I'm not looking forward to future episodes at the zero lower bound, so I think it's extremely important that we make sure that we hit our inflation objectives so that we've got at least as much cushion as we're supposed to have when we find ourselves in this situation. But, I'm with Ben Bernanke on this. He has said, and he's a scholar of the 1930s, Great Depression, and he said if you look at the Great Depression and the shocks that hit the system then, and you look at the shocks that hit the U.S. economy after Lehman, they were bigger. They were bigger more recently, and the unemployment rate was horrible at 10%, but wasn't 25%. And I think it's all of the efforts that, the Fed undertook in conjunction with other people in the administration, the liquidity programs, the stress test, and making sure that the banks had capital. So, we need to make sure we have that capability, but it'd be good to sort of also make sure we have the most vibrant economy so that we've got inflation and we're at full employment, so it's less likely that we have to face this soon.
Well, I think that brings us to the next question, really, because you mentioned inflation. R-star, if indeed the long-run real rate is falling, how should the Fed adapt? I think Eric sort of announced what I think is the standard view. We keep a 2% inflation target, and that means we're going to end up at 3% and probably run into the zero bound every recession. But maybe I might channel Charlie saying, well, maybe what we need is more headroom, and we need to get the nominal rate back up to 4% or so, and that just means we're going to have to raise the inflation target so we have more headroom. Or maybe, as discussed in the committee, in the panel earlier, maybe we need to rethink the whole business, go to sort of just a changes in growth rates things, or more extreme, let's go to zero inflation or a price level target or nominal GDP target. How do we adapt to this if this low real interest rate world keeps going? You want to start off with I guess I forgot which way I went last time. No, so it's Eric's turn to go first. So you can go with the higher inflation.
Well, I just
target.
had an intervention, so you could go to Jim.
Oh, okay.
Start in the middle.
You got to be flexible.
No rules.
Is that discretion or rules?
Pure discretion on this panel.
You want me to go?
Yeah,
All
go
right.
ahead.
On R-star, the main failing of modern macroeconomics is the treatment of the trend. So the even estimated models will often say, we're just going to take averages over long periods of time. We're going to relate those to the balanced growth path that underlies the model, and then we're going to analyze a lot of fluctuations around that balanced growth path. But we know, both from looking at U.S. history and across the globe, that these trends do change over time. Now, in the model, if the trend changed, then that would change the behavior of everyone in the model, and so that would have to be taken into account. I've actually worked on models that are like that. They're not easy to work with. But from a policymaker perspective, we understand that these trends might be changing. One way to handle changes is to look at regime switching type models. I like those because they keep some level of stationarity in the system as opposed to a random walk. You can say that, let's say there's a high growth regime and there's a low growth regime. You might be switching very occasionally on 10 years at an expected length in a particular regime. And then but given the regime, everything behaves as it would, as if that was the balanced growth path forever. And then you can make monetary policy, but in order to make monetary policy in that environment, you have to know which regime you're in. So I think this is a good conceptual way to think about R-star. Eric just outlined some of the things that you might think are lower today and were higher in the past. Productivity growth is low today, was higher in the 1995 to 2005 period. Labor force growth was higher pre-crisis, has been lower post-crisis. Both those things would feed into this balanced growth path and therefore into the real interest rate associated with that path. In addition, you've got this longer run trend for increasing demand for safe assets that's been going on since the 1980s. So you had a period where there was relatively normal demand for safe assets. Today you have a situation where there's high demand for safe assets. That's pushing the safe yield down as well. I like this kind of framework. I think it keeps policymakers more on their toes about what's actually going on in the economy. and without disrupting the entire framework and saying that you can't do anything because you don't know what the state of the world is. I would be sympathetic to the idea that you could go with growth rate type policy rules that would do a better job of tracking where you were in this regime switching world, as opposed to simply assuming that you're always dealing with a constant balanced growth path. So I think I'll stop there on R-star.
We had a very good session earlier in the conference about estimating R-star. It's not observable. There's a big standard error around any kind of equation that economists run, but I'd say that R-star in particular has a fairly large standard error. So I agree with the empirical work that it's quite uncertain, but I do think, given what we're seeing in productivity trends, which there's a lot of uncertainty about whether they'll continue or not, I don't think there's that much uncertainty about what the population trends are going to be, that the Fed doesn't get to pick productivity or population growth. And for those that want to make sure that we don't do asset purchases, they have to come up with an alternative of what they're going to do when we hit the zero lower bound. And so whether you think it's exactly 3% or not, it's not 5%. And I think it's pretty clear that it's not 5%, which means in most recessions it's going to be a problem. So I don't really think that the R-star estimation is really what's going to be driving whether or not we hit the zero lower bound, because even though there's a pretty big standard error, as I added up between what the inflation rate is, the population growth, and productivity, it seems very unlikely we're not going to hit the zero lower bound in most recessions. So I think it is important to try to estimate it. It's a good policy tool. I don't think that it's something, though, that hinges on whether or not we're going to be using balance sheets in the future.
You had wide-ranging questions, so let me pick up on sort of the different ways to do policy aspect of this. So I tend to favor, especially given where we've traveled from over the last 10 years, focusing on outcome-based policy, making sure that when we have a long-run strategy, which is well informed by modern macroeconomic theory and the natural rate going back to Milton Friedman, and having an inflation objective, which is price stability, good central banking, that we follow our strategy. And so we're focused on making sure we provide monetary and financial conditions to support full employment, that we state what we mean by full employment. So that's why we adjust our long-run statement every year, and that's a very natural thing to do. And we talk about what our inflation objective is and how it's symmetric. So 2% is not a ceiling, but that we're going to be have to go above 2% periodically and also be below that. So outcome-based is very important. Now, this isn't necessarily just discretionary, but it's not following any one particular rule all of the time. We need to use models, look at models, and we have to recognize, as Kevin said, we have to recognize when those models have obvious shortcomings. And so like the financial sector or the international sector, macroeconomics as a literature has not had to fit these models to match the data for the U.S. post-war experience to a first approximation. Then other people come along and you add that. So when you're facing one of these more unusual circumstances, more like a tail risk, you need to be mindful of the fact that my analysis doesn't cover that, and we have other analyses that we have to add on to that and be very artful to. So it's very uncomfortable if you're accustomed and would like to have a nice single unified model. Doesn't exist. And I think that's a statement about the profession, not just central banks. And Stan gave a very good talk this morning where he mentioned that Don Cohn had said that the committee's been informed about Taylor rules and different alternatives going back as far as 95. So I think we have to be mindful of these tail risks, which means if you look at a tail risk, that means you need to be making a judgment about when the center of the distribution is not what you should be focusing on. And a rule is going to be focused on the center of the distribution. It tries to be robust against this, but if you're really going to be looking at tail risk, then you need to be thinking about, now I need to do something a little bit different. I think that's what the Bernanke Fed did in response to the financial crisis, 10% unemployment, and the fact that inflation was not expected to get up to our objective anytime soon, and the rest of the world was slow to get there, but then they were further behind.
But I want to press you guys on this. If the zero bound is a problem, why not raise the inflation target to 3% so you got more headroom? I want whoever wants to say something to go, and you could say, no comment if you want to go on to the next question.
Okay, let me set you right on this. So
I don't like the idea, but.
If you have higher inflation, you're distorting the economy all the time because of the higher inflation. So do you want to distort the economy every day so that on occasion you're able to conduct a little bit better stabilization policy? The literature has a clear answer to this, which is that the distortion caused by the everyday inflation is much bigger, order of magnitude bigger than the benefits of the stabilization policy. That's the received wisdom from the literature. You can do other models and stuff, but that's the way the debate should be stated. I don't think that the additional benefits from better stabilization policy would outweigh the day-to-day distortion that would come from the higher inflation target, and so I don't think that's a good trade-off. I also think that there are things you can do at the zero bound, including quantitative easing. I have been an advocate. It's not perfect, but there are some things that you can do, so it's not like you're out of ammunition when you're at the zero bound.
Well, I'll take the answer I like and move on. Because I also notice you guys are taking the productivity and thank goodness population growth as exogenous to the Fed. Whereas, of course, there's an alternative story that it's secular stagnation and the Fed should be doing more about it. And will you?
About what?
About productivity growth and labor force participation, productivity.
The thing that
and-
Solo said was the residual and the measure of our
Not my
ignorance.
theory. I just want to point out that you're going along with this. Okay, you're telling me to move on. Let's.
I'll keep asking. I'm okay.
Well, I'll get to ask it again in the next one. The lessons of the recent quiet period. Marty Eichenbaum put up a very interesting graph. The Fed, along with me, and it seems everybody else, got forecast after forecast wrong, expecting the robust recovery that never came. Marty used it to say people are irrational expectors, but of course those were Fed forecasts. Maybe we're all irrational expectors too. The Phillips curve fell apart. The deflation spiral never came. Growth is too low, but does that have anything to do with monetary policy? Or maybe we in Japan are just living the optimal quantity of money and growth is too low for real reasons. I mean, in the end, the Fed achieved its objectives: low inflation, maximum employment, at least that monetary policy can give you, and tiny interest rates. Maybe we should just have a big party. So what lessons do you see from this recent, surprisingly quiet period?
I'll start. So I agree with what Charlie highlighted early, that monetary policy should be focused on outcomes. So focusing on inflation and unemployment is something that we should definitely be focused on. You've just stated a whole bunch of things that can change over time, and in which there's a fair amount of uncertainty about what values they are at any particular point in time. It really kind of reiterates Stan's comments earlier about having a fixed policy rule, that if you think a lot of these relationships are uncertain and possibly changing, the last thing you want to do is tie yourself to a rule that might be wrong. So we do have an ability to monitor what's happening with inflation and unemployment. I think actually that should be the focus of congressional oversight, which is when we're missing on both those two variables, which they've highlighted, that is a discussion that we should really be having. But I'm not sure having Congress or the GAO determining what goes into the process of getting that outcome is actually particularly productive.
Okay, so the question is about the quiet zero lower bound, and I would take the main lesson from this era to be that, to paraphrase Friedman, near zero interest rates do not everywhere and always imply higher inflation. That's a puzzle, which I don't think even now the profession has come to grips with. It came out of left field. I don't think anyone expected that. And I would say most of the people in this room If I had told you 8 years ago where interest rates would be 8 years in the future, and I had told you what the size of the balance sheet and the monetary base would be, you would all have said, I bet inflation is high, or at least higher than target, and you would have been wrong. So that has been a shocking development from the point of view of received economic theory. At the St. Louis Fed, we're kind of overachievers on providing new ideas, so we provided two possibilities. Possibilities on what was going on or what might be going on. One is to bring out the Ben-Habib, Schmidt-Grohe, Uribe type analysis and think about the possibility that there's another steady state. That steady state is very robust across models because it only relies on the idea that there's a Fisher relation and a Taylor rule and a zero bound, most of which would be in any of our models. And maybe we're somehow getting stuck at that steady state, or you could interpret Japan as Ben-Habib et al. Did, as getting stuck at that steady state. I still think that that's a reasonable idea. I'm not sure that you really want to bring it in as the main focal point of monetary policy, but that's a reasonable idea about what has happened. And the other idea is neo-Fisherian, where if you just keep the interest rate low for a long time, or a permanent peg, as John Cochrane has, what eventually will happen is that the private sector expectations of inflation will come to be consistent with the very low nominal interest rate, and all that will happen is that inflation will come down. So that seems to be a good model for Japan as well. 20 years now with the policy rate below 50 basis points, and not too much on the horizon as far as changes. So after a while, private sector throws in the towel and says, well, I'm just going to expect the amount of inflation that's going to be consistent with that level of nominal interest rates, given that the real interest rate has to be determined by supply and demand conditions in that economy. So that, I'm not saying neo-Fisherian effects would, immediately dominate, but if you're going to move the policy rate for such a long period of time and keep it in the same place for such a long period of time, I can envision that it's private sector expectations which adapt, and as opposed to real output or other variables.
So one thing that I think Jim just sort of demonstrated quite well is that, he's been willing to bring different views forward to the FOMC, different regimes, neo-Fisherian thinking, Schmidt-Grohe and Uribe, and I'll be honest, I don't always like it. The neo-Fisherian, we're gonna, get inflation up by increasing interest rates is, kind of counter, and so I'm not sure that's right, but I benefit from talking to my staff, having them educate me about things like that, and, we sort of understand where those results come from, and I think we benefit from that. Either you buy into it or you kind of go, oh, that involves a slavish devotion to the Taylor rule all the way down into the deflationary spiral, through the gates of hell into Hades, all the way down and not stopping. Because if you stop, if you've got some threshold, then that's going to kill the transversality condition in the infinite limit, and then, okay, we don't have to think about that one anymore. But this is new. So it's a way of getting around groupthink that Kevin mentioned. I spent a lot of time talking about forward guidance and explicit thresholds as a means of trying to communicate to people who are skeptical, who always thought Marty's chart said the funds rate was going to be forecast to go back up, because it always has. And every time it was forecast to go back up, then you kind of go, we're not getting as much accommodation in place as we would like. So some way to demonstrate, with commitment, conditional, that we were going to be there as long as that was useful. And we had good committee discussions and all that. Eric has talked about financial stability issues and, areas where we could run, afoul given the exuberance, and if we ended up having to experience a period with the unemployment rate increases, those are risky propositions, so how far should we go with all of this? I think those are examples of, the committee's benefiting from, and Stan mentioned this in his comments about different perspectives.
So I'm getting a sense that one response you might have to Kevin's worry about groupthink is that regional Federal Reserve banks are an excellent antidote to groupthink, and allow you to come up with alternative ideas to bring to Washington.
So let me just follow up on
All
that.
things in good measure.
Yeah. Let me just follow up on that. One of my favorite examples is actually Charlie Evans. So this is a mutual admiration society here. So, but Charlie came with the idea of thresholds for policy. When he first gave the threshold speech, I didn't know what he was talking about, and I had never heard of it or even thought that way. He stayed at it for about a year, maybe more, and lo and behold, that entered into actual FOMC policy. Now, if the chair had gone out and said something about thresholds, all hell would have broken loose. So I think there are some advantages to having the big committee in a world where it's been turned upside down. You do need new ideas to flow into the policy process, but you can't just spring them on global financial markets. You don't know what would happen. So there are advantages to this system that we have of allowing different viewpoints to be stated and to try out different ideas before they actually get into the full weight of policy decision making.
So let me move on to some issues that Kevin Warsh brought up in his talk. In public, the Fed talks a lot about point forecasts. What should we do assuming the economy continues to grow, inflation stays low? What's the path of normalization? It's sort of it's a very quiet scenario that we were talking about, and with lots of do we raise 25 basis points first and then slowly squeeze down the balance sheet later and so forth. And there is a danger that this starts to feel like our congratulating ourselves on the great moderation in about 2006. The Fed puts banks through stress tests. Surely there are stress tests for monetary policy too. Now, you may not want to talk about this in public, but what scenarios keep you guys up at night? And what scenarios keeps the Fed up at night? What are the stress tests about? And what should the Fed do? How can we avoid being caught flat-footed once again when the next, surely somewhat unpredictable, but in retrospect, it looked predictable crisis comes? Do you worry about China blowing up, Euro blowing up, the U.S. states blowing up, some sort of sovereign default, banks, student loans? I don't know. What are you thinking about for where the next crisis might be, and what's the Fed going to do about it? In some sense, the Fed is. As long as inflation stays under 2%, that's not really a job anymore. And crisis management is much, much more of what the Fed's about. What keeps you up at night?
Well, I'll answer the first part about stress tests. I mean, with the Teal book, we do have different scenarios that we look at. And we look at scenarios where there are shocks that are unanticipated. For example, something happening in China or Europe that we didn't anticipate. And also just the uncertainty about economic relationships, that maybe we have a very different set of economic relationships than our standard models are telling us. And so the staff normally puts together 4 or 5 of those kind of scenarios. That is part of the discussion at each of the meetings. My own staff also goes through various scenarios that they think might be relevant to think about. Those scenarios change over time depending on geopolitical situation, depending on which economic relationships are breaking down. So I think we do think about these various scenarios. We tend to be focused on the modal forecast because it's much easier to explain the modal forecast than it is to explain standard errors, fan charts, and all the uncertainty that goes around these relationships. But these are things that we actually do around every meeting. And so when you look at, if you go back 5 years where you can actually see the Teal books, part of that discussion includes these various scenarios. And so, and each meeting, those scenarios do change as different economic data comes in. So I completely agree with you that we should be spending a lot of time thinking about what goes wrong. Those things change from over time, and that is something that we take into account when we have our deliberations.
I agree with Eric. We do scenarios. I think it's a good thing. We definitely look at, well, what if productivity comes in lower than we think, or what if various shocks hit from around the world, China, hard landing, things like that. But let me just elaborate a little bit. I don't think that what we do is sufficient, and so in that sense, I would agree with Kevin Warsh's comments. If you think, here's how I think about robustness. So if you have a model where everything's going to return to the balanced growth path no matter what you do, and it's just a matter of how big the deviations are going to be, that's going to give you one view of the world and one view of the type of risk that you have to manage. But if you have a model that says most of the time you're on the balanced growth path, but sometimes all hell breaks loose and you go to a completely different state of the world, that gives you a very different picture of what you're trying to do. Because in that world, all you're trying to do is stay away from the edge of the cliff. You don't really care about the fluctuations around the balanced growth path. You just want to say, well, what types of policies are going to keep me from falling off the cliff? We don't have that kind of stuff. We don't talk in those terms except anecdotally, and it's not part of our models, and we don't work with models that have problems like that. So there are models in the literature. Probably the best known sequence of papers, there must be several hundred papers on Diamond Divig style bank runs, and then there, in those types of models, you're thinking about, well, what gets rid of the bad equilibrium, what keeps me from falling off the cliff. And that dominates the thinking in that literature. We don't have that for ordinary monetary policy. We treat the world as if it's quite a stable place. Even though you could be subject to pretty big shocks, you would still eventually come back to the balanced growth path that you started with. So I think we could do a better job on that dimension.
So, I mean, the kinds of things that, I worry about, and I've talked a lot about this, is basically, the risk that we end up back at the zero lower bound, or effective lower bound, however you want to describe this. Now, by the way, I'm not that optimistic about all of that digital payments currency where all of a sudden it becomes easy to sort of implement negative interest rates. I don't think those are very politically popular, and I'm not sure how that would be perceived, but the jury would be out on that. But I think that zero lower bound risks are really important. That is, what if inflation picks up? We know how to deal with inflation. We know how to raise rates. It's not good. We'd rather not be there. Volcker had to go through an awful lot, and it was extremely costly, and you wouldn't want to dissipate that credibility. But, we do know how to raise rates. But providing more accommodation when there are other factors that are not willing to provide that accommodation and the economy is suffering in a big way is very challenging. So that's why I think all of these issues are very important. Now, just to provide a little more balance, I mean, I have for the longest time sort of not given a lot of airtime to what if the low inflation risk does turn into a high inflation risk, because frankly it's been hard to imagine. But John, I've never quite understood all the ins and outs of the fiscal theory of the price level. I mean, there's a certain elegance to, that consolidated intertemporal budget constraint that you point out, but all of the ins and outs of when the active fiscal policy versus passive monetary policy, or that I always sort of go back to Leeper's very important paper in '91, and I've got a colleague, Leonardo Malozzi, who's sort of taken parts of that. So for a certain period of time, like maybe 8 quarters, 2 years, you have one where the fiscal policy becomes irresponsible. That's what kicks this all off. Deficits are so large that the real value of the debt has to go down. How's it going to do that? Well, it's going to go through a price increase. And you can get some of those large inflation rates, and that would be very challenging, because those are times when monetary policy and fiscal policy are actively acting against each other, and the equilibrium is not really well laid out. That would be challenging. That puts you into sort of the realm that Jim, I think, is talking about, sort of outside of the normal approach.
Well, a global sovereign debt crisis would be challenging.
I just have one other thought that I wanted to hit on here, that the idea of this 84 models or 80 models, and that you should check what's going on with, in many different frameworks, and then try to, this was what Volker Wieland was talking about and John Taylor last night, that you should try to check against a wide variety of models and then see which things jump out at you as being consistent across all the models, and then which things are not. And that might be a good way to get better robustness in decision making. So I actually think that's quite a good idea, as opposed to what we do now, which is that we take really FRB US and then we run the different scenarios in FRB US. So now you're getting to a world with better IT, better computing. You could probably do the 84 models with, not exactly the push of a button, but you could probably automate a lot of that and look at different scenarios and different models.
Quantity versus quality on models. I like it. So I'm going to ask you guys one last question, then we'll open it up. There is an elephant in the room. I won't ask you to comment on the Choice Act or other specifics, but clearly this is a moment when our country's rethinking the Fed's general structure, the nature of congressional oversight, your relations with the Treasury, and I welcome comments that you're willing to make on good or bad aspects of this. How should reporting be improved? Should it be more relative to rules or not? Do you favor the separation of monetary and policy and regulation? Should the Fed welcome some limitations on what it does, because limitations on actions are also limitations on responsibility? Should the Fed and Treasury come to a new agreement or accord and stop this business where the Treasury sells and then the Fed buys it? I mean, really, who is in charge of the maturity structure of the debt anyway? Should the Fed and Treasury routinely swap securities so that the Fed doesn't end up holding maturity and credit risk for long periods of time, as Charlie Plossard has suggested? Any structural issues of that sort you're willing to comment on?
So I'll take you had a long list there. So I'll take a couple of them, though. We've talked a little bit about rules. I want to emphasize that we look at rules. We spend a lot of time looking at rules, and we don't just look at one or two rules. We look at lots of rules. So I think it is very important to think about rules, think about why you're diverging, coming up with coherent explanations for why you're coming up with a different answer than a particular rule. That is very different than legislating a rule that you have to follow and gets audited by the GAO and results in congressional hearings. So I'm not in favor of legislation that would provide a rule or have us regularly provide a rule and then have to meet it for many of the reasons that Stan highlighted. So that aspect of the legislation I don't think is particularly productive. You mentioned supervision. I actually think that it's impossible to divorce monetary policy and supervisory policy. One of the reasons the financial crisis was such a serious problem was because financial institutions had such serious problems as well. And in fact, it's not at all unusual around the world that in instances where recessions coincide with severe problems in the financial sector, that they're much more severe, they take much longer to recover from, they have very broad implications for society in general. So I do think it's important that we understand those trade-offs. The topics came up in a couple of the questions earlier. I don't think we can divorce the supervisory responsibilities from the monetary policy responsibilities. I think we have to think about those two things and how they interact. And that is a very important aspect of what the Federal Reserve does, and I wouldn't want to see that change.
I'm going to mention some areas of Fed reform that I think that I've advocated in the past that I think we could actually do unilaterally without congressional action, and that I think would help alleviate some of the pressure that exists on the Fed. One thing I think that we could do is have press conference at every meeting, make each meeting ex ante identical, allow the committee to move at any juncture. Other central banks do this. We're one of the few that doesn't, and so I think this is important because the markets and the wider monetary policy community wants to hear from the chair, because the chair is the person that speaks for the committee and only the chair. And whatever you decided a month ago or 6 weeks ago, there has been intervening data, and there's been this and that has happened, and they want reassurance that you're still on track, or if you're adjusting slightly, they want to know that you're adjusting slightly. So, my vision of communication is that communication should be more or less continuous, because developments in the economy are more or less a continuous process. If you had a model and it was continuous time and Brownian motion, the policymaker would be actually reacting in continuous time. So you want this idea of, continuous communication in epsilon amounts. So almost nothing is being said on any particular day, but because you're communicating all the time, markets are never surprised by the nature of the monetary policy. So I think press conferences would put us in a step in that direction. As it is now, between press conferences, we're at the mercy of the speaking schedule. Sometimes that doesn't work out also all that well, especially over the holiday period in the U.S. sometimes. So I think we could do more on that. We could also have a monetary policy report at a quarterly interval, which I think would be important to lay down a baseline for markets and for the policymakers and the committee itself. Here's what we're thinking in some very basic level about what's going to happen in the economy. You could compare notes with what private sector forecasters are saying. You could do this and that. And then everyone on the committee could give their own views relative to that baseline. So I think a monetary policy report could go a long way to improve Fed communications. In addition, I think that report then could include all kinds of reporting relative to monetary policy rules, because let's face it, John Taylor revolutionized how we do macro and monetary economics, and we already give long speeches in terms of monetary policy rules. Janet Yellen did it here herself at Stanford just recently, but this has been going on for years. We already talk in terms of monetary policy rules. We could put that into the report in the appropriate way, and this would give a benchmark to everybody about, okay, here's what this rule says, and here's some reasons why we're not doing exactly the prescription of that rule, or the committee's judgment was that that wasn't the right thing to do at this point. So I think you could get this idea of rules reporting going if you had this monetary policy report. So I think, now none of these things actually require legislation, so I think the Fed could actually take steps to go in this direction, and then we might not stress our lawmakers quite as much because they've got a lot of other things that they need to be doing.
So it's, extremely important for us to be accountable to, Congress and the American public, and to explain, what we're doing. I often think that as central bankers, we use language which always strikes me as a little bit arrogant. We need independent monetary policy. In a democracy, independence, what are you talking about? That's why accountability is really so important. So the chair goes up to Congress and testifies twice a year, scheduled, talks to the JEC. The taper tantrum started when Bernanke made some comments at a JEC testimony, and they go up other times when called upon. So I think that's appropriate. Because of accountability, it's natural for us to talk about communication. I mean, you could kind of wonder, why do you always have to talk about communication? It must be a sign that something's not right. But, how transparent are we? On the quarterly reports, let me just offer a minority opinion on a slightly different topic, which is the dot chart. Now, the dot chart is something that you either like it a lot or you do not like it. You say you don't understand it. And I think Kevin said that he thought that the dots were on top of each other. They might be on top of each other for, the end of the year when there's no action that we could do that's different than what we all know that we will do. But the dots, 1 year and then 2 years, it put on full display our disagreements. When somebody's got, like 8 increases over the next year or 2, and then somebody's got none. And people ought to want to know, why is that? And so I think that's one reason why people go out and explain that. I think, that they're very useful. And, another way, Charlie Plosser, I apologize I didn't ask you about this ahead of time, but I hope you would sort of agree. Charlie and I didn't always agree on the policy, over the next couple of years. But what's interesting is I'm pretty sure we might submit the same inflation forecast 2 or 3 years ahead, and probably the same unemployment, or that output growth would be at trend. What was different? The underlying assumption about the economy and what policy was needed, and the dots are what show that. So some people thought, I'm going to get there, but I'm going to get there because I'm fighting inflationary pressures. And others would say, I got to get inflation up. And so I think that's very informative, and that's part of what we need to, have the public understand us.
Well,
Hope
thank
that
you.
was okay.
Unless you guys have some important thought you want to do, I'm going to go on. Okay, now I promised I'll reserve the first 3 questions for our ex-FOMC members, and then everybody else gets a chance. So, you guys got something you want to ask? Yes, Charlie, I knew you.
Those of you who've known me a long time know sometimes I can't keep my mouth shut, but I have a couple of questions. I want to follow up briefly on Charlie's last point, since there's a degree to which I take some responsibility for the dot plot and having it be there in the first place. And I spent a lot of speeches and time trying to explain to people what it meant and what it didn't mean. And you often use the example that Charlie just gave, which was that we may have the same forecast, but we have very different ways of getting there, our underlying policy assumption. And partly what's incomplete about that is that readers of the dot plot or readers of the SEP can't match up those forecasts of the individual forecasts with the person's dot. And many of us argued for a long time that printing the full matrix would be helpful in understanding some of these issues. That's just an aside. I actually want to I have 2 sorts of questions. One, I want to, both of them sort of were stimulated by different comments up there, but the first is about kind of working in reverse order, is Jim's comment about monetary policy report and how we treat rules. At this conference, 3 years ago, I think, I gave a talk here where I said what the Fed ought to be doing in the first steps towards more systematic policy behavior is actually make the rules that the staff produce and the outcomes of the rules that they look at, make those part of a monetary policy report. And that has 2 benefits, I think. One is it's not adopting a specific rule, but it's forcing the communications of the committee to reveal its logic and thinking behind their decisions and explaining why they may deviate from or where they lie in a range of rules would be helpful communication and revealing a strategy. And that talk, I think it was 3 years ago, must have been. But I'm glad Jim's talking about that. I hope the committee is continuing to do that, because I think that it would have been true by doing that, you could have headed off some of this stuff that the Congress is trying to dream up and being more proactive rather than defensive. And by the way, Mike Dotsey and I think Mike's Philadelphia is still doing it, is providing a sort of model report about how you might go about doing that. The other question I have, and this is probably more philosophical than anything, but I heard some differences up there, and this is the question about tail risks. This has come up a lot, and how central banks are naturally a worrisome lot. They wring their hands, and they're always worried about what can happen. And I suspect that's appropriate. It's kind of the nature of the beast. But I'm worried a little bit about our perhaps overstressing, unusual events and thinking about them as being sort of regular events. So, for example, when I was first learning macroeconomics and building models and thinking about models for the macroeconomy, a very common reaction you'd get in academic circles, well, that's great, that looks good, you've got everything working fine, we understand it, but it can't explain the Great Depression. Your model doesn't explain the Great Depression. If it can't explain the Great Depression, then I'm not interested in it. Well, we still don't understand the Great Depression. It's 80 years later, and people are still writing papers. There's revisionist views about what happened, why it happened, what policies worked, what policies didn't work. Leo Hanian's been on this sort of writing about different ways of thinking about what the effects of fiscal policy. So there's a lot we don't understand. I think there's a lot we don't understand about this crisis too. And I suspect 60 years from now, economists are still going to be speculating about what happened and why. So the point I want to make and try to ask is, do we get too focused on tail events and risk not using policies that may be demonstrably effective and useful in normal times, do we not do those because we're afraid of some tail event, or we think we understand a tail event that we really don't understand, and it gets us in the way of using good policies? And this was illustrated, I think, in Jim's point about inflation, when you asked him about, do we have a higher inflation? Well, the argument is, well, you know, yeah, we could have a higher inflation rate, and it might be better for some periods of time, but it would impose costs in all the normal times that we really don't need that. So making the trade-off for policies in their design, how do you think about that? Do you design policies or design mechanisms that solve only the big problems and then not worry about the normal problems, or vice versa?
So
I think it's an interesting kind of philosophical approach to thinking about the institution and policies. I'll stop
So
there.
I'm going to treat that as a statement, not a question, which, by the way, is welcome. And let me remind other people, say who you are. Unless you guys have something important to say. I want to
You could collect a few questions, and then that's probably the most efficient way.
That's fine
nudge
with
me
me.
when you, or when you have something to say. That was a great statement. And
I can nudge, you speak up.
who else would like to ask something or say something? Yes.
It's Bob Heller. I heard a lot of willingness to engage in future open market operations, you know, QE type operations. And if I look around the world, the biggest risk I see out there, people talked about this black swans, is the insurance companies and especially the pension funds. A lot of them are underfunded by enormous amounts. And so how are you going to deal with that if you then want to do QE? And also in the same vein, if you have higher inflation, and some people have advocated that on this panel, a lot of these pension funds, they are fully indexed because they're public pension funds. So higher inflation is no way out of the dilemma that you're facing. So you've got a big black swan that you can actually see. What are you going to do about it?
I'll rule that a question.
Are we collecting things?
No,
or-
go ahead. I think you can answer that jointly with Charlie, too.
Well, let me combine the two, actually,
There you
because
go.
you're talking about a specific tail risk. And I actually do think that understanding what could cause problems for leveraged financial institutions is critically important. So insurance companies, banks, other types of financial intermediaries that could be significantly impacted. So Charlie made the argument for maybe we spend too much time on tail risk. I'd actually make the opposite argument, that it's really costly to have an unemployment rate at 10%. If I have an unemployment at 4.4 instead of 4.6, that's not a huge problem. But if I have a 10% unemployment rate, that is a huge problem. We're still suffering a decade after the last event. A lot of this discussion is tied to what happened with that event. So the problem with tail risk is that it has long tails, that it takes a long time to recover from that. And so I think we should always be asking ourselves, what are the kinds of problems that could generate those kind of very severe outcomes? I agree with your point that you don't want to construct a design for what kind of monetary policy you want to run just for bad outcomes. But recessions are not, in some respects, that big a tail risk. They happen periodically enough. It's not like it's one every 50 years, it's one every 10 years or so. And so if you design a system that every time you hit a recession you're going to have a problem, that's probably not an ideal system. You should be thinking about the tail risk, trying to avoid it, and monetary policy may not be the right tool to try to avoid it. And I think some of the issues that were discussed relative to insurance companies, pension funds, they're probably regulatory rather than monetary policy approaches that are, I think, far more appropriate.
Let's go. Yes,
Well,
please.
the long-duration liability managers have obviously been challenged during the environment of low interest rates, life insurance companies, pensions, and it's very easy to go to some event and then sit down at dinner and find that your hosts have steered you towards sitting next to people like that, and then they kind of go, well, you know what, interest rates are low and you're really hurting them. Also, people who've done everything right, you know, throughout their life, the savers, and now all of a sudden interest rates are low. So I mean, it is the case that, monetary policy has tried to reduce longer-term interest rates through portfolio balance effects in order to induce more risk-taking to get us, back towards better growth. But after the taper tantrum, term premium went up 100 basis points, and then we ended up, retracing that, and it wasn't because we expanded our asset purchases and all that, but worldwide interest rates have been falling. There are many factors at work, and many of the ones that George Schultz was talking about in terms of AI and 3D printing and how is that going to impact different segments of the population, and trend growth rates are lower in R star. So it's not just monetary policy, but monetary policy does, live in that space during these periods where we're having to deal with the zero lower bound. That's why I say the zero lower bound is the risk that worries me the most, because I'm not sure that we could handle this. And if it's got the digital currency and you can all of a sudden get negative interest rate, well, that's only worse for that. So.
I think I got Dennis next. Yeah.
Dennis Lockhart, formerly with the Atlanta Fed. I'll ask a fairly concrete question about, say, 2018 policy, and that is the relationship between tapering the balance sheet and rate increases. What's your current thinking as to how much accommodation will be removed through various scenarios of tapering the balance sheet versus increments of 25 basis point increases in the policy rate?
Well, you've only been retired a few weeks. You know the answer to this.
I remember the discussion, but I want to hear what you guys, maybe what happened last week.
I consulted the minutes of our March meeting carefully during the break just to make sure I understood, what we had all said, and it's pretty much what people have been saying in speeches, which is that, the committee is looking forward to the upward sloping funds rate path that I would say is pretty confidently in place. Fundamentals for the economy are good. And so, we're moving up towards this place that we have described as a committee when it is well underway that the rate increases have been taking place, and then we'll start adjusting the size of our balance sheet by not reinvesting the maturing proceeds coming off SOMA. The minutes indicated that many participants thought that this could begin before the end of this year, and also that there have been discussions about whether or not we would let the full amount mature and not be reinvested. I think that if you look at the monthly patterns, some months have larger maturities, and that could get in the way of some of the Treasury funding, and so just sort of smoothing that out is one possibility, but I'm not sure it's necessarily essential. So those are some of the issues that we've talked about.
Yeah, we adopted this regime switching view. We think we're in a very low real interest rate regime for a variety of reasons right now. We don't really see the factors affecting that regime switching very soon. So over the forecast horizon, we have a very low policy rate path. We're actually, our dots are definitely not sitting on top of everyone else's dots. I think if we went up 25 basis points or even 50 basis points, I don't think that would be the end of the world. But what I do object to is the idea that you have to go on this very long march up to 200 basis points or more over the next 2 years in order to keep unemployment low and inflation near target. I don't think that you have to do that given the current circumstances. So. And then if that's the view that you take, and you should, then the logical thing to do is to allow the rest of the yield curve to adjust normally and naturally, and so you'd want to take the pressure off of the longer term rates that's coming from the big balance sheet. And so I think you could allow the runoff of the balance sheet, and you could manage that, or you could let it all run off, and the chair will have to make a decision about that.
Okay, if I go on?
The committee hasn't made decisions on this, so I can only speak for myself. But I would say my preference would be that we start reducing the balance sheet relatively soon. and that we do it in a highly tapered way so it can serve in the background. So if it's highly tapered and it's going to be pretty gradual, then you can continue to focus on the federal funds rate as the primary target for meeting your inflation and unemployment objectives. And so that would be the two principles that I would be focused on: highly tapered, so it's not disruptive, so that's not the primary tool that you're relying on. And I wouldn't wait all that long. I have a slightly different view than Jim. We're at 4.4% unemployment. My own estimate for where full employment is 4.7, so we're already low. A lot of the private sector forecasts have GDP growth that's in excess of 2%. My own potential is at 1.75. That would imply continued pressure on labor markets. So I am a little worried that we need to take away the accommodation. We've been doing it very gradually by historical standards. I think that's appropriate. I want to continue to be doing it gradually, and the best way to do it gradually is to probably continue to do it so that we end up in a situation where we really are hitting both our dual mandate in terms of both inflation and employment.
Marty, you've been waiting patiently for a while.
I just wanted to raise a question about the interaction.
It's coming.
There's an important interaction between regulatory policy with respect to banks and many of the questions we've been talking about here, for example, the level of R-star or the size of the balance sheet. Let me give you two examples. One is because of liquidity coverage ratio and the way common equity tier 1 ratios are calculated, the weights for things like excess reserves, et cetera, obviously the demand for safe assets has gone through the roof and has arguably contributed a lot to the fall in interest rates that are related to R-star, right? It's not a one-to-one thing, but certainly they've contributed to an increase in the demand for safe assets. And so if we think about that trade-off, right, do we want to increase R-star a little bit by giving or cutting back on some of these bank regulatory ratios? That is to say, and you can actually see what's true in banks' portfolios. They've gone from 4% of holding treasury bills to something closer to 8 or 9%. So it's a very real and concrete thing. Another example of that is the size of the balance sheet. If you suck out all of these excess reserves, they have zero, they get no haircut in the liquidity coverage ratios. That's going to have a big impact on your ability to do so. So I think it's important as we go forward to not think of regular monetary policy and the size of the balance sheets as independent from our views about the right way to regulate. So any comments would be appreciated.
So, yeah, I mean, part of the regime idea is exactly that the demand for safe assets has increased, not just in recent years, but over the last 3 decades. The 1-year ex post real rate on a U.S. Treasury was in the 5% or more range in the mid-'80s. It's now, minus 1%. So you're down 600 basis points. It's a long-term trend. Doesn't look like it's turning around anytime soon. If you talk to people in financial markets, they say exactly what Marty Eichenbaum just said, is that, well, we're being required to hold these safe assets for various regulatory reasons. So the demand in some sense has skyrocketed, not just in the U.S. but worldwide. So what do you expect? The prices are going to be very high and the yields are going to be very low. But these are exactly the rates that are most relevant from a monetary policy perspective and are providing the baseline for a Taylor type policy rule. So this is part of what we've taken on board in our regime view, in addition to lower productivity and lower labor force growth. And that's why we think we're in this low rate environment, at least for the over the forecast horizon. So I do think there is some interaction. I'm not sure I'd go so far as to say, well, you should back off of those kinds of requirements on the grounds that you want to have a higher R-star for monetary policy. I think monetary policy should probably adapt to the regulatory policy environment, and that's what we're trying to do.
I'll take a slightly different, so I completely agree with your fundamental point that when we think about monetary policy, we have to be thinking about how supervisory policy interacts with it. Liquidity requirements, though, I think are actually a critical component of how we think about what happened in the last crisis. So The dependence on wholesale funding was one of the reasons why investment banks had runs and why we had the kind of problem that we had during 2008. So I'm not sure the answer to safe assets is to allow the banks to once again get into a situation where they're potentially illiquid. I actually strongly believe that we need to focus on making sure that financial institutions are able to weather kind of liquidity shocks. And so I wouldn't do it by pulling back on the liquidity requirements. I do think that the Treasury has a way of actually providing more safe assets. So debt management, if it's worried about this consideration, could be issuing much more at the short end of the market to relieve some of these concerns. That seems much less costly, particularly for stress scenarios, than trying to change the liquidity requirements. So that would be my preference for how to address it. But I think your more general point, that whenever you think of system design for monetary policy, you have to take into account how regulatory requirements interact with monetary policy design, is a critically important feature of what we should think about.
What Marty brings up is that there's two sides of this balance sheet. There's the assets and the liabilities. We kind of got ourselves into talking about the assets, how you buying very long-term debt has affected the long end of the yield curve, and Marty brings us back to liabilities. Wait a minute, these vast quantity of reserves are actually now important, not just because of reserve requirements, but other things. Perhaps the other way out of the conundrum is the Fed gets rid of the longer-term assets in the MBSs, but keeps a large balance sheet funded by short-term treasuries, and that way you can keep the big reserves as well. No, says Charlie.
No, I'm trying to figure this out type of thing, because I was kind of thinking, well, we'd be taking the treasuries off the market, so they like those safe assets. Okay, but you're right, we'd be supplying also safe reserves and all of that. So that was my back and forth on that.
Did you want to say something?
Yeah, I don't think reserves are a perfect substitute for short-term treasuries. So I think the treasuries are more valuable in the marketplace.
Reserves are more valuable, treasuries are more valuable than reserves. Yes, that's an interesting observation.
Yeah.
I've got 5 more questions lined up, but one of our rules is we end on time, and it is on time. So the 5 questioners, you'll just have to come back next year along with everybody else. Thank you, everyone, for coming. Thank our panelists.